What crowdfunding did, which I'm so proud of, is it reversed 70 years of securities law. It used to be, if you want to raise money for an opportunity, you could not do a public outcry. Hi, I'm Doug Ellenoff. I've got this new idea. I want you to give me money. That's a public offering, and you would go to jail over that. What we were focused on then, because you have to remember the Jobs Act was jobs, is he tracks how many jobs have been created as a result of all of these newly incorporated entities. And it's hundreds of thousands of new jobs. So it's worked. So Reg CF has worked. The SEC, to their credit, raised the maximum that you could raise in a Reg CF from $1 million to $5 million. Originally, they fought us tooth and nails to back to. One of the things that we've not talked about that we do a lot of are just financings generically of public companies. The ability for sub-billion-dollar companies to raise a common stock offering anymore that in a non-highly structured transaction is few and far between.
You ready to launch?
I'm here for you, buddy.
All right. Welcome to the next episode of Exploring Prosperity. Today, we're joined by Doug Ellenoff, a pioneering attorney who's been instrumental in shaping legislation for crowdfunding and special purpose acquisition corps, or SPACs, significantly democratizing access to capital markets over the last several decades, right, Doug? It's been 4 decades? 3 decades.
Did you invite me on a guest to get me depressed? But yes, it's been about that long.
It's been a while. Anyway, I've had the pleasure of knowing Doug since over all those years, since our college days, and I'm thrilled to have him on to share his insights with us today. While surveys reveal broad pessimism about the prospects for the next generation, America's standard of living has steadily improved despite societal worries all along the way. It's reasonable to assume that Adam Smith's invisible hand contributes to that. It's the sum of the actions of millions of productive individuals working at what they do that creates the stability and the consistency of economic activity that benefits us all. Doug, I'm particularly enthusiastic about bringing you on because your hard work has opened up a massive new source of capital to small businesses, as well as having opened up a world of investment opportunities to individuals that the government had been inhibiting for years. I'd love to start by hearing about your journey in shaping crowdfunding.
Bob, I am thrilled to be on. Always great to catch up with you, and I look forward to exploring with you some of the things that I've done that hopefully may be interesting to your audience. That you in particular will understand my orientation. When I got out of law school, I did not go to a large law firm. I went to a small law firm. My father was a securities lawyer. I liked entrepreneurship. Like a lot of young lawyers, I decided whether or not I was going to actually go into business and follow in the footsteps of somebody like yourself who was doing all these interesting things that I was precluded from. But I started my own law firm and was in obscurity for quite some time, just working with young entrepreneurs and small companies. And along the way, I had to decide for myself, is this what I want to do for the rest of my life? Or, and I keep coming back to our origin story, was I going to compete more effectively in order to do something more meaningful? And for your audience's benefit, Bob and I spent a lot of time playing squash matches against one another. And it was very formative. It's not just fun. Like any competitive sport, you have to analyze where you are in the match at any given time. And I knew that my career wasn't where I wanted it to be. And I was watching a lot of transactions take place, and I wanted to figure out where our law firm fit within the legal landscape for doing transactional work. We were not going to be competing effectively for IPOs, major M&A work. And we did come across the beginnings in 1993 through 2000 of the SPAC industry. It started with Rule 419 in 1993, and it was fledgling from 1993 till around 2000. During that same period of time, let's say my law firm was coming up on 15 years old at that point, we realized that we had done a lot of reverse merger work, which is a cousin to the SPAC business on a much smaller scale. The size of the deals are smaller. The principals involved are less well-known people, and the underwriters and service providers are were much less well-known as well. So a perfect place for us to get a toehold position in and see if we could grow with this program.
This show is being brought to you by our sponsor, Trueflation. Professional investors and economists, and probably any casual observers, know that government inflation statistics are only an approximation of what real inflation is. Not only that, but the government has a conflict of interest because high inflation can be so damaging to the economy, the deficit, and our $34 trillion in debt. Trueflation collects over 13 million pricing data points. Most are updated daily to reveal inflation with precision for asset managers, governments, companies, and the general public. Check them out at trueflation.com.
And we knew we didn't want to be known as a reverse merger firm because that had been stigmatized well before. But SPACs being blind pool vehicles, and maybe your audience does or doesn't know what a SPAC is, Bob. So I'm not sure if you want me to take a second.
Yeah, actually, I would love to. Can you explain what a reverse merger is and what a SPAC is, so that we have the basics down?
And that's why when I call them a cousin, you'll better understand. So a reverse merger, typically, otherwise known as a shell corporation, was a private company that went public in a traditional IPO typically, and then failed on its mission. Now that public company has shareholders, but no operations because the company that was entrusted with its original capital just didn't work out, not through any nefarious activity necessarily. Sometimes things just don't work out like in the venture world. And now you have a public vehicle with no operation in it. And during my early years of practice, I came across this program, and what you would do with that public vehicle, this shell company, with no real assets or liabilities, or hopefully no liabilities, is you would reverse merge a private company into the public shell, thereby making the prior public entity a public company. And the private shareholders would get the vast majority of the shares in the public company that had been a different company weeks before, and now it's a new company, and presto, you have a new public company. That was very controversial when it first happened, and part of the reason for that is that the regulations didn't require that the private company that was going public through this reverse merger process immediately disclose who they were now, and what their financial statements were now. Over the next 10 years, the regulations caught up, and you now have to file documentation so that investors understand that at the closing of that reverse merger, this company is not what it was, it is what it is now, and here are the financial statements. And it's just a means to an end, an alternative way of taking a private company public. There are variations on a theme of it, but that's the gist of it. And what you're really doing is you're creating value for the public shell where there wasn't one because the prior opportunity failed. Done innocently, nothing wrong with it. But in fairness to regulators and investors that have had bad experience in the reverse merger world, a lot of nefarious activities played games with it. But the New York Stock Exchange today reverse merged into, I think it was ARCA, and that's how it got public. So these things are iterative, and you have to start in one place and then bank on it with your own effort and initiative, improving on these programs over the years. Okay, so that's reverse merger. And that was when I first started practicing securities law, the firm that I was with did that work. So I was very familiar with reverse merger work.
And not many other firms did. Is that right?
That's probably a fair statement. There was a limited number of people. It was highly stigmatized. It was not well regarded, and it tended to be entrepreneurial activity. It was not big business.
And the main reason the private companies wanted to get into the public shell was access to better capital markets?
Primarily, and
Yeah.
liquidity. Yeah.
Yeah.
Yeah. And it's episodic in the capital markets, Bob, and you know this. There are times when there's more money available in the private markets. There are times when there's more money available in the public markets. But back in those days, before we ruined our public markets, in my estimation, gross
Yeah,
exaggeration,
no, I want to talk about that because
it all went to the private world the last 30 years. So it's better to stay private than it is to go on public. But yes, so that's what a reverse merger into a shell is. A SPAC is a mature version of that. Should I jump in?
Sure. Yeah.
Okay. So in 1993, the SEC, which was decidedly unhappy with decades prior what are called blind pool offerings. It's kind of funny. Blind pool offering is what a hedge fund is. You raise a pool of capital and then you deploy it. That's a blind pool.
Yeah, because you don't know ahead of time what assets are going to be acquired by the money, by the manager of the money.
By definition, it's de novo. Okay, so that's private equity and venture. But God forbid you do that in the public markets. Regulators don't like that. But that had been done. And so the SEC created a rule called Rule 419 of their own making to determine how you could avail yourself of the public markets with a blind pool offering, otherwise to be known as special purpose acquisition corporations. And in essence, what it was a public offering. So you could offer securities to the public, like in a traditional IPO. There has to be an underwriter. And then that money goes into the coffers of this usually newly created corporation to be used for the sole purpose of acquiring a single asset. Now, the rules were not as specific as the way we have come to know them. As I said, all these programs are iterative, whether or not it's reverse mergers or SPACs or crowdfunding or registered directs and pipes and ATMs and ELOCs and all these and things that we'll talk about. But back in those days, commercial participants in the SPAC program negotiated with the SEC. So the money that's raised in the IPO immediately upon being raised goes into an escrow fund. People call it a trust account, but it's not really. It's an escrow fund. So it has to stay there until the closing of the proposed future business combination. If there is no such deal, the money goes back to the original investor, the public investors, not the original investors, the public investors. Or if an investor says, this deal stinks, I want nothing to do with it, I want my money back, you can redeem, and it's been true since 1993 as it is today, and get your money back.
Yep.
So that's
shareholder votes on the acquisition proposed by management and yay or nay. And if it's yay, then you proceed, the deal closes. And if it's nay, then the funds get distributed back to
a
the
little more
original
nuanced
investors.
than that, Bob. It's not a majority rules. If I don't like the deal, even if I can have my money back. So people and the press routinely talk about SPACs in a negative light, but that's fairly investor friendly.
Right. It's optionality on both sides.
Correct. And to make matters more interesting, in today's SPAC market, well, let's go back. You get a unit, a share of common stock, which is for $10 in today's market. The $10 sits in the trust account or the escrow account, and I get a warrant. So if the deal is well received, the value of that warrant goes up. So I can keep my warrant, so strip the warrant, but I can ask for my money back. There's also interest being earned on that escrow account. So I can walk away getting my money back with interest, hold on to the warrant on an unlevered basis, get high single-digit returns. So a SPAC is a blind pool offering to raise money for the newly created public company, for the management, the sponsor, but the management of the public company to go find a private company, more often than not, but it doesn't have to be, it can be an international publicly traded company in some cases, and take that private company public. And so it is a IPO followed by an M&A transaction.
Mhm.
That's what a SPAC is. And they're
One of
listed on
the one
NASDAQ
of
and NYSE. Sorry.
Yeah, and I think, one of the things that people don't completely understand is the market moved over when it got popular. The market moved such that the sponsors needed to actually often put in a lot of their own money. And so when they when the investors redeemed, they wound up losing their money very often.
So again, part of the narrative that the press doesn't pick up, which you're right about, is they have a binary outcome typically, the SPAC sponsor. So in order to form a SPAC, you have to find an underwriter who thinks that your investing background is such that it merits raising $100-200 million from the public. And in order to do that, you have to put up millions of dollars. And you get 20% economics, like most traditional private equity and venture firms. The SEC can't stand that, can't get its head around why you get that sort of, it's not a carry because it's actually from $1, but you get 20% economic stake in the newly created company. It starts off as 100%, gets diluted down to 20%. And then when the M&A transaction gets done, you get diluted further. So you really end up with 3 to 5% plus a warrant package. But that's in exchange for putting up millions of dollars. Those millions of dollars are paying for the expense of the IPO, the ongoing costs of the public company, and the due diligence and all the transaction fees associated with the business combination, so that it's that money that basically is going back into the redeemable securities pockets from my pocket as the sponsor, so that there's enough money to pay everybody back. And if there's no deal that gets done, or if everybody hates the deal that I propose, I get Zippo.
At the time that you started working, when the SEC passed the regulation in 1993 to allow for SPACs, is that right?
That's correct.
And at that point, obviously the market was zero. The reverse merger market may have been something, but measured in small millions of dollars, probably, right? It wasn't highly active. Talk about the progression of and the growth of it and the challenges, because I assume that you needed the reputation of both of these activities was such that you needed regulation to help it along, I assume, right?
That's what that's Rule 419 was, right? So it starts off as a negative in any market when you were doing what you wanted without regulation. Then the regulators pass a rule, and now you use that as the foundation and the security to operate under. So there were some very clever individuals who used Rule 419 and trademarked the name SPAC. It wasn't part of the Rule 419. They named it SPAC. Now, what I've done, because you'll be entertained from a marketing perspective, from 1993 to 2000, Bob, which is the incubatory period that you're referring to before it kind of becomes more mainstream acceptable, I've referred to as Generation 1. We're in Generation 4. And so Generation 1 had maybe a universe of total of 50 SPACs over that, call it 8-9 years. They were all sub $50 million vehicles. And when they were largely small business owners who sold their businesses, were sitting at home with a pile of cash and had nothing to do. And they wanted to get out of the house. And they said to a few of these underwriters who were big in it at that time, hey, put me back in business only with a little bit of my money, but I'll go find a new company to run. And these small business, and at that time, the SPAC sponsors only had to put up a few $100,000, not the large money that you referred to. And exchange, they got the same sort of 20% economic package without the warrants. And so they went about their business, and they would find small businesses that made marginal public companies. And they got this industry off the ground with not a lot of fanfare. It was with law firms and investment banks and accounting firms that you wouldn't necessarily, are not brand recognizable. But they bought small companies and that actually hung around in the public markets for many, many years. In many cases, they ended up getting sold to strategics, and they did okay. And almost uh, into the high 90s, a SPAC that did an IPO found a private company and did the reverse merger and got it done.
Otherwise, there's no point in that you were getting a talented businessman who could sell the idea to a private business of combining, and it all made lots of sense. And
Right, but today, just to be clear, Generation 3, which just ended, let's say call it in 2023, that started in 2021, we did 800 SPAC IPOs, 800, Bob, in just that period, and over half of them failed. So you intuitively said, yeah, the early ones, the 50, they got, of course they got deals done. But as the program exploded in 2021, there was too many SPACs, too few private companies that wanted to go public. And those sponsors that put up those billions of dollars lost all of it.
yep, I was in the stock market at the time. It was quite obvious that there were too many of them. And we started hearing that when they were going on the road shows, they were all expressing great confidence in how many companies they're talking to. And I started hearing from some of the SPACs that I knew, like, it's really hard. There aren't very many companies that are out there that we can really look at and hope to acquire. And then there also is a little bit of a stigma, wasn't there, on the private company side? If you could go public in an IPO, you'd rather do that than sell into a SPAC. Did that wind up happening?
Well, I'm glad you raised the point because it's really a bit of a head fake issue. So when I started practicing 30 plus years ago, we as a country did nearly 1,000 traditional IPOs. We are so below that
A
hard
year.
a year. We
Yeah.
don't even do a couple hundred traditional IPOs. And there are a lot of macro dynamic factors that you're probably very well aware of. FINRA regulations on broker-dealers doing IPOs are very, very difficult. Selling to retail investors causes lots of liability. So the SPAC market in part responds to the ever-declining IPO market that only really wants to do very well-known tech-oriented deals. And that's how the brokerage firms make a lot of money. Think of the SPAC program, and I have for decades thought of it this way, as outsourcing that same sort of responsibility from an underwriter to a credentialed executive from an industry who knows where those quality companies, the private companies are, and helps take them public. I'm not saying it's always happened that way. That's the platonic vision for it. Many times they lose their orientation and they try and do a deal outside of their core expertise, but that's a mistake more often than not. But what ends up happening, as an example, last year, 100 private companies went public through those same several hundred SPACs that I referred to earlier. The year before, the same thing. That's significantly more than traditional IPOs. So the point I'm making to you is, yeah, everybody ideally would like to go public through a traditional IPO, but that's full. Everybody wants to play in the NBA, but most people don't get there. And that doesn't mean these are all bad companies. I just reject that out of hand. There's a whole other subset of companies that have good growth prospects. They may not be backed by venture firms, and they deserve to be in the public markets if that's what they want.
That's exactly right. You do not, what has happened in the financial industry, as has happened in many other industries, is this concentration and over-regulation, so that the only things that make any sense are the large deals, the large companies, the large interactions, where it completely inhibits economic activity and the flow of capital in all of the smaller regions and small businesses and smaller businesses across the country, which is exactly how you start losing your advantage as an economy. And so and you just talked about the 100 deals in the last couple of years. what has the size of the market done? And we haven't, we're talking about SPACs, but crowdfunding also was a very huge success. And that didn't, and actually I should ask you, what is crowdsourced funding wound up doing? I know that there were a number of public companies, there wasn't a lot of activity, and then SPACs kind of took over the limelight. But both of those areas together democratized the flow of capital both ways.
Yeah, I mean, I think just to end your last thought, your previous thought, which is it's regulatory risk management. It's easier to regulate big than small. So the regulatory strategy for decades has been larger and larger investment banks, too large to fail, too big to fail.
Yep.
And that's why all of a sudden you wake up one day and there are no public companies. We've gone from 8,000 to 4,000, and they're in the private market, so it's not a headache for the SEC because they're private companies. But it's unfair to public market investors because these growth companies are not coming into the public markets.
Let's keep on that just for a second, because I listened to Jay Clayton when he was the head of the SEC.
Yep.
And he said the number one priority for us is to get companies public. There's too much. Individual investors used to be able to buy great companies early in their evolution. And the private equity world has taken over. And there are a lot of reasons that are contributing to this. Investment banking regulations is one of them. But he also pointed out that the regulatory burden on companies as public companies has grown so much that it makes it less attractive to be a public company. And he said, we're looking at all the different reasons for this, and we're hoping to be able to make some inroads on it. But I don't think he did he?
Listen, I think Jay was well-intentioned, and I think the observation is the correct one. Now I'm going to go back to 50,000 feet rather than drilling down into SPACs. So I think of myself as a disruptive regulatory lawyer. And so I'm constantly watching to see the ebbs and flows in the capital market where there needs to be more resources and efforts. So think of SPACs as the retailization of private equity, right? These are high quality sponsors bringing companies, in theory, to the public markets that individual investors can now participate behind the likes of the top private equity and venture firm managing members. Even if it's not always worked and the results are not great, that's the concept. And it's not for regulators to decide, oh, these returns stink, therefore this program can't exist. That's not the way Congress authorized the SEC to administer our capital markets. It's not a merit review, it's a disclosure-based regime. And as long as you're telling the truth, even if it's a bad company, you're allowed to take it public. And I believe in that. Okay. Investors can say, we hate the SPAC market, we're never investing there again because the returns have not been great, but that's up to them. Okay. So what crowdfunding is, that when I heard about crowdfunding, and I'm very proud of my experience from 2012 on, I went down to Washington 50 times to make it happen. I worked with the crowdfunding industry. I traveled around the world because two things were happening. And one of them is what you're talking about with Jay Clayton, and it wasn't just Jay. I testified in Congress on this, it's the retailization again, or democratization of the venture markets. It made intuitive sense to me that you can go online, see a pitch, and then decide, like Shark Tank, if you want to invest in it in an online regulated market. I am, as a securities lawyer, a believer in regulations. I'm not like a crypto person, which believes that there should be no regulation. I have seen retail investors get harmed by opportunistic, predatory folks, and there is a place for regulation, but the balance is so far out of whack most of the time that it is the impediment that you referred to, Bob, that prevents entrepreneurship from really fulfilling its destiny. But what crowdfunding did, which I'm so proud of, is it reversed 70 years of securities law. It used to be, if you want to raise money for an opportunity, you could not do a public outcry. Hi, I'm Doug Ellenoff. I've got this new idea. I want you to give me money. That's a public offering, and you would go to jail over that. What crowdfunding enables you to do through a regulated portal, regulated by FINRA, who regulates broker-dealer activity in this country, and the methodology by which you can do this, you have to speak to counsel to understand how to do it, but you post your idea or business online through one of these regulated portals, and then investors are taken through a process to verify who they are, how much money they can invest in a very measured way. You can't, as a retail investor, throw your net worth at a small opportunity and take a shot. That's not what this is about. This is about giving people an opportunity, a controlled opportunity, not more than 10% of their assets, a few $1,000s to participate. The thought process was start off as doing it like a friends and family round, not in the backyard in the barbecue, but in this public forum. And then hopefully 10, 15, 20 years later, and now we're 10 years later, you can raise a much more meaningful sum of money for a further along venture opportunity called a Series C or D round. We haven't gotten there yet. It's going to take longer for this to happen. But to your point, many thousands of companies have availed themselves of Reg CF crowdfunding. There are different types of crowdfunding. There's retail crowdfunding. There's accredited investor crowdfunding. There's another thing called Reg A plus crowdfunding, which is quite an oddity. But these are all programs under the Obama administration, to give credit to that administration, that enables retail investors to participate in venture opportunity, responding exactly to the point that you and Jay Clayton were making, that we want people to have earlier access to taking a shot in venture opportunities, even if, and most likely they will, lose money.
How hard was it to get this stuff done? It just sounds like the most horrendously difficult process because it required an act of Congress, didn't it?
So the Jobs Act is 100% congressionally driven and presidentially mandated. And here I've spent a decade working within the existing SEC created rules. It was not Congress that created Rule 419, it was the SEC. And it was a lot of anguish that went into helping formulate the better ways to do SPACs from 2002 to 2012 as an example, because 2012 is when crowdfunding comes along. I see crowdfunding, this guy, Woody Neese, and his partner, Jason Best, who went down to Washington, walked the halls of Congress, and got Patrick McHenry, who's going to retire this year from the head of the House Financial Services, who's been a wonderful advocate for crowdfunding. And they got bipartisan support that year in 2012, because we're still in a rough economy, to create this entrepreneurial program. When I tell you the SEC was certainly not a fan of most of it, that's understating it. Silicon Valley was very much in favor of accredited investor, not crowdfunding, but
Requirement.
Requirement, exactly, 506C. Nobody really cared about
Which basically, just to recap, what that really means, accredited investor, is you have to have accumulated some wealth or have a position of high income, or else your money is no good.
Correct.
You can invest and we're not going to take it.
You can
And it's
be
illegal.
a business school professor at Yale, where Bob went, and if you don't have the net worth or the income, you can't play. And we've tried to change that as well, Bob, and not with great success. So it wasn't
At least the accredit, at least back in those days, it was required, right? If you were not accredited, there was virtually no ways that you would ever be able to invest in a small business.
That's correct. That
Yeah.
is correct. And from a regular, if you were the head of the regulations, you too would say to yourself, okay, we're going to let wealthy people put their assets more at risk than people with lesser means, because the people with lesser means, if they get burned to too great an extent, they're going to become dependent on the state, and it's a problem. So I'm very sympathetic to the concept of how the regulations work. And what's great, I said there were three different versions of crowdfunding. Reg CF crowdfunding is that any American can invest up to $2,500 in any of these deals. And so I love that, because that's the American dream. Even though it ends up not being out of 330 million Americans, I'd be shocked if 5 million people 10 years later have participated in Reg CF, because they know that it's more likely than not going to lose money. But you can go on any one of a number of Reg CF crowdfunding sites and look at these deals and invest in the local brewery or whatever it may be. And that was the most regulatory sensitive. So in direct answer to your question, it was imposed upon the SEC that they had to allow this to happen. But it took from 2012 to 2015 before we got the final sign-offs. So that's why we're 9 years into the cycle for Reg CF. And that's because most regulators are large law firm folks. They've never seen anything like this. And it just was offensive to them that we were going to let any American invest even a small sum of money. And so, like I said, I was down at the SEC 50 times in that 3-year period. I was in front of Congress all the time. And you had to be a believer. And everybody who was down there, it wasn't just me, it was a bunch of 20 and 30-year-olds who wanted to see this happen because they believed in the online capital formation business. And there are organizations that I'm still with today that are dedicated to making sure that this industry survives and thrives. So that's Reg CF. Then to your point, there's what's called 506C, which is only for accredited investors. You don't have to do it through an online platform regulated by FINRA, where you can say, I have this great new idea, and email it to everybody you know, post it on LinkedIn, and you can only accept money from accredited investors that you verified through a third party actually are accredited. If they end up not being accredited, the burden's going to be on you and you're going to have a problem. Okay. Those are the only two I'm going to really talk about. I'm not going to talk about Reg A Plus, which because it's really just a public offering by another name. But that was transformative, and thousands of companies have raised money with that. And the hope is that that's somewhat of a farm team to create a new class that will either get sold privately or maybe find their way into the public markets.
Are there any databases, consulting firms, evidence, or do you have a suspicion about how many of those thousands of companies that received crowdsourced funding, crowdfunding, would not have received any funding and never gotten off the ground?
That's a double-edged sword, right? Maybe they shouldn't have gotten money when you ask it that way. But so there's a very dear friend of mine is a guy named Woody Neese, who was really the pioneer on the idea of crowdfunding that walked the halls. And he's got an organization called Crowdfunding Capital Association, Associates, that you can go, called CCA, that you can go online and look at. And he's got a lot of the data. What we were focused on then, because you have to remember the Jobs Act was jobs, is he tracks how many jobs have been created as a result of all of these newly incorporated entities. And it's hundreds of thousands of new jobs. So it's worked. So Reg CF has worked. The SEC, to their credit, raised the maximum that you could raise in a Reg CF from $1 million to $5 million. Originally, they fought us tooth and nails. Back to your earlier point, we were debating every single aspect of the crowdfunding provisions with the staff, and one of them that got debated in Congress before is the SEC didn't want them to be able to raise $5 million, so it got knocked down to $1 million But because there's been so little problems with the Reg CF crowdfunding industry, the SEC on its own bumped the amount from 1 million to 5 million, which is a huge benefit because it means if you're a successful entrepreneur, you can raise more money, even though there are ways of doing what we call hybrid offerings, where you're doing a Reg CF with a 506C offering so you can raise more money. So there are ways around these things typically. But to the SEC's credit, they did that. They recognized that the previous narrative that there was going to be all this fraud in the crowdfunding industry was erroneous, and truthfully, it was used to serve its own interest, even though the statistics didn't bear it out previously and certainly don't bear it out now.
Well, it's, that's comforting. There are plenty of people that think that people are bad, and there are plenty of people that think people are good. And it's nice to know that when an industry gets going, thousands of companies get funded by probably millions of people, right?
Yeah, absolutely.
That the incidence of criminal activity is small. Any idea how small that is?
Almost statistically insignificant. I mean,
Wow.
less than like 1%. So here's why, and this is why I always believed it's through a regulated portal. Number one, so they're like a mini broker dealer, and they have rules and responsibilities as to how they onboard an investor. Now, a lot of the times that where a regulator is unhappy with a capital formation process is that they believe that investors have not been told the correct story. They're sold a bill of goods. Well, in an online environment, it's all digitally recorded. So you can show whether or not you did it or properly or not. And FINRA is regulating the crowdfunding platforms so they can dictate or monitor how it's being done if there are enough complaints to shut it down. And it's just intuitive that there's no way the SEC would have raised the amount from 1 to 5 if they weren't very statistically comfortable that there weren't a lot of complaints coming in. Now the cry is to go from 5 to 10 and to raise the maximum amount people invest in a deal. And so the industry, and you can, is it okay if I mention a couple of the sites for people to check out?
Sure.
WeFunder is one of them. There's one in Texas. Then there's an accredited crowdfunding site for people who want Israeli technologies called Our Crowd. That's not for Reg CF because it's international. It's for accredited investors. And I'm not saying that the results, Bob, have been outstanding because I think we just don't know that. It's worse probably than the venture model, right? Where you're going to have 1 or 2 successes that make up for the rest in the venture model. Here, because you're not going after the moonshots, otherwise they would go the traditional venture route. You're probably going to have some adverse selection, but a lot of these deals are also structured with debt, particularly in the real estate crowdfunding. And you just get a return. You can go to Realty Mogul and look at that website for that. So the point you're making, which is it used to be everybody was excluded from these deals unless you happen to know the entrepreneur and you happen to meet them at the right point in time and they offered you some part of their deal. Now you can go on these sites if you like consumer products or beverages or software deals or teams and participate in these things more proactively. And I think that's welcome. Even if the results are as poor as friends and family financing. I don't know about you, but I have rarely gotten my money back on those deals. So this isn't going to be any worse.
No, that's the thing. And the world, in order to make progress, you must take risk. You have to work hard. You have to be able to make a bet and a prediction and participate and contribute, because a lot of times you put money in to family and friends or whatever round, no matter what, it still may take a little work. But the whole idea is,
sorry, go ahead.
Yeah, no, the economy does well when small business people are active and interacting, and money can flow
So
to
let's do
ideas.
two more things though in that.
Yeah.
So one is, well, I'll get back to SPACs in a second, but if you go on the CCA website, you'll see the amount of empowerment for women and minorities which venture does not give money to, has been significant in crowdfunding, all forms of crowdfunding. Next, geographically, even though the money is always going to skew California, New York, Texas, Massachusetts, the dispersion geographically has been very healthy in many other states. So particularly for entrepreneurship, that's an outstanding thing. But then to your broader message, which you and I are completely aligned here. So even though SPACs, a lot of what I'll call the aspirational venture SPACs of 2021 and 2022 were lithium battery deals, electric vehicle deals, satellite deals. Let's say every one of them craps out. The technology that was created by those companies that ends up getting acquired by one of the winners is good for society. And as long as investors didn't get burned because they were defrauded in the classic sense, like in Nikola, as opposed to some technical reason that the SEC wants to hang you for, I'm very comfortable every single day that we did good. We did good.
People need to be able to make decisions on, on whether a business is good or not and benefit from the wins and take the hits on the losses. You want this flow of capital. And speaking of that, so crowdsourced funding did not exist at all until what year?
2012, 2015, it started.
And what LendingTree was part of crowdsourced? What happened with LendingTree?
So there were two deals at that time, LendingTree and Prosper. And those were for debt lending. They did not use any of these exemptions because they actually started prior to. They actually used the SEC registration statement process. So they were not exempt the way these other programs are. And if you're exempt, it costs a lot less money. If you have to register, it's a lot more expensive. And they figured out mechanisms that they negotiated with the SEC as to how they could do things in a regulated environment in a much more cost-efficient and efficient way generally. And I think they started off with very low default rates, and everybody was very, very impressed. And I think over time, as they became a more mature business, the numbers caught up with them. I think both are around. I used to know the Prosper guys pretty well, the LendingTree guys not so much. But all the debt lending sites, I think for the most part, the numbers caught up with them and their default rates ended up being greater. And those are to be distinguished versus, let's call the philanthropic lending programs that were done throughout, for example, sub-Saharan Africa, where you just wanted to give money for a good cause for somebody to buy a cart so they could peddle their produce more. Sorry.
Did that come from, did the use of crowdfunding for nonprofits spring from the regulation for the?
No, it existed before, actually.
Yeah.
The first crowdfunding that was non-securities based crowdfunding, where everybody was talking about it, and for some reason it's just escaping my mind right now. One was called Indiegogo, but the other one was even better known, where Oculus got funded. That was with donations and rewards and advance pay to create things, but you never had an economic ownership in those enterprises, and therefore it wasn't a security.
Doug, one of the things that seems so evident to me is this concept of centralization, decentralization, particularly, the success of Wall Street creates a regulatory overreach, and it creates a concentration, and then you get this crowdfunding as well as SPACs leading to a decentralization. Tell me about the interplay between all of that, both from regulatory and Congress and from what you're seeing in the private sector.
Well, I think you're hitting it right on the nose, Bob, which is every action has a reaction, right? So if you have over-regulation in the public markets and people get concerned that they're paying too much, things are too difficult, there's too much liability, don't be surprised if everybody tries to do an end run after that. And so the crypto world, Bitcoin, cropped up in 2012 just as crowdfunding is happening. And I'm saying to myself, ooh, which one do I do? And I spent a lot of time on Bitcoin in 2012, and I read a lot of information about it because it seemed like it was my kind of disruptive uh, technology, particularly as it related to something that may touch the securities industry. And my conclusion was that these are securities. Now, the SEC, I think, has done.
When you say these are out of curiosity, in 2012, it was 2015, I think, before Ethereum was created. And so are you speaking about Bitcoin as a security or Ethereum or the others since then?
Everything after Bitcoin, as I watch it, particularly not only Ethereum, but the hundreds, thousands of other coins,
Yeah.
um, I didn't care about Bitcoin so much. I could see the argument as to why that itself was not a security
Yeah.
per se. But where I started the thought process was no matter what analysis I was here coming out of Silicon Valley with all of the law firms out there, no matter how they were rationalizing their analysis, I knew the way the SEC was thinking about these things because crowdfunding is decentralized in many ways as well. And I know that the only thing that the SEC focuses on, primary, is they don't want to see retail investors lose money. Now, you have created an environment by not regulating crypto where retail investors and everybody else can throw their entire fortunes or net worth into an unregulated coin through an unregistered broker dealer. And what could go wrong? So even if I could have gotten comfortable, which I didn't, that some of these things were not actually securities. A, I didn't want to see investors get hurt or be involved with anything like that. And B, I knew there would be a whole lot of hurt because even if the SEC was wrong, I knew that they would bring enforcement actions and go after the people who, at the very least, were nefarious and just taking the money, but also people who were negligent in how they housed the cryptocurrencies. And it's actually shocking to me that a lot of people in around that hustle didn't find themselves in a whole lot more hurt. But that's why I went the crowdfunding route, even though I always paid close attention. And so and if you read the books on the early thinking of crypto, these are, I'm not saying they're anarchists, but decentralization was specifically intended to be extra territorial from the government. And that's why it funded assassins, it funded drug dealing, and it has not really been broadly embraced for commercial purposes in terms of commerce. Yes, a lot of these cryptocurrencies do very interesting things for storage and other things like that. And I think it's going to be really interesting going forward. And I'm an investor in a crypto fund because I do believe in blockchain. But the shame in my mind is that the SEC and the industry and Congress didn't get together in 2012, 13, 14, and 15 and prevent the significant losses that ended up happening during the crypto winter. And for the SEC to spend the amount of time that they did on SPACs instead of on that, I just blown away by that.
I am blown away by that too. I just cannot understand it. I am not that aware of how much time they spent on SPACs. I knew that there was a mountain of work there, so I knew they had to be spending a lot of time, but I am shocked that they didn't take a look at FTX early on and some of these exchanges that are even the ones offshore. How easy is that? And even just they could have easily come out and declared really simply, if you're running a new token, a new protocol, and you have a centralization issue around, if you aren't decentralized at a certain amount and you are raising money through selling tokens, you are a registered security and you cannot do that. I don't understand why they didn't come out clearly at any point, and they still are not clear on it. It's
So,
really amazing.
so a couple of things. The first thing is, let's assume that definitionally, under the Howey test, that the crypto, which is the definition of a security, that it does that the Howey test doesn't capture fully whether or not a token is a security or not. Then it is your responsibility to address it immediately, to recognize that there's a problem, go to Congress and come up with a new framework to deal with what ends up being a retail problem by definition. All of the bad activity that we've seen in the public markets for 100 years and the way things are sold with front running and making false volumes, so it appears that things are trading more regularly than they are, illegal markups, all these sorts of things were being done in the crypto in space.
Rampantly.
Right. Okay. And I'm not
And
even
it was
talking about,
and it was two engineers with a computer
yeah,
going tick, tick,
exactly.
tick, tick,
No
tick, tick,
infrastructure.
send.
The crowdfunding portals, the Reg CF portals that are regulated by FINRA had more infrastructure than many of these places that were taking in money. And I understand that it's difficult because some of it's offshore. But anyway, as I said, a lot of attention should be paid for any new program from 2012 to 2015. Address it, analyze, and get it right. SPACs were around since 1993. It was done through the front door of the SEC with their own rule. We went through hell and back, to your point, from 1993 to 2003, and we had gone through all the discussions with the SEC forthrightly, and then for them to wake up in 2021 and say, well, we don't like SPACs. Really? Where were you the last 20 years? Whereas in crypto, yeah, they were aware of it, and I know they had a task force internally, but they should have created a new regulation. And if you believed it was a security, then you should have said to all of the participants, you need to register this token with the SEC. And we tried that and we worked with people, and the SEC said, we're not going to let it happen. So you can't have it both ways. If you're not going to cooperate with industry, industry is going to find its own solutions, and don't be surprised if you're unhappy with them. And so I think the whole thing, even though I take a serious issue with this SEC, generally speaking, and a lot of their rulemaking, whether it's climate change, hedge fund fees, SPACs, I don't think they're wrong as it relates to crypto. And it's not really their fault. It really is Jay Clayton's and others who didn't go after the industry sooner. And when I say go after the industry, what they could have done, like they should have done with SPACs, Bob, is they should have said, we don't like what we see. Come on in and see us. We need to address this. I don't think most people, including the Wild Wild West, want to be on the wrong side of the SEC. And if they wanted to have a dialogue and a spirit of cooperation, like we did in crowdfunding, which is what I'm so proud of, you sat down, you hashed through all the issues, and you got to the best result. I think that's what they should have done with crypto. They didn't, and I think a lot of the industry is elsewhere in the world, for good or for bad.
I was under the I saw that the SEC asked people, crypto firms, to come in and talk to us, and a whole slate of them got no clarification and then later got attacked. Is that what you're referring to?
Oh, well, that's lip service. I mean, actually meaningful dialogue where we're actually going to accomplish something like we did with crowdfunding, but Congress mandated in that case, so they had to do it, even though they dragged their feet. And the people at the staff were wonderful during that period. They really were, they're so smart. And so when they wanted to be helpful because they were motivated to be helpful, it really worked. In this case, it shouldn't have taken an act of Congress and McHenry to say to the SEC, figure this out. They have securities law regimes they could have fit this into, in my mind, and they just chose not to. And so the whole thing ended up being a nightmare. But part of it is that I think the West Coast, in particular, Silicon Valley law firms lobbied long and hard and put the SEC in a tough spot.
Interesting. Very interesting.
When you see the inner workings of these things, It's often much more tortured and ugly than you realize. The part of the thing that I was saying, and this is yeah, one of your observations, Bob, is these things are not clean. It's easy to be a policy purist, but there are a lot of constituent parties that have strong feelings about these things, all of them patriotic. What I learned when I was down at the SEC, these are very smart, well-intentioned people, even if conceptually I disagreed with them. I would never vilify any of them, even though I think some are more intellectually consistent than others. But I also watch senators and Congress people generally who I've testified in front of put a lot of heat on these folks. And if they don't do something and people lose money, they hear about it. And that's part of the problem. You and I are capital formation people. We want to see the money flow. And I do believe the SEC is wrong-minded in preventing investors to put money up if they're fully advised, even if they're going to lose money. Conceptually, that's the way we've designed our markets to work. And when somebody comes in and they try and overturn decades of policy, that's problematic in my mind.
And you pointed something out earlier too that's important. It's not the regulator's job to make a judgment decision on whether an investment is a good idea or not. And I think that there is a belief among regulators, and it's natural, that their job is to protect investors. And so it's easy to reach over the line by mistake, and it's even easier to do it on purpose. And I think we find too much of that.
Well, I'll give you two really good examples. And obviously, one example here or there doesn't really change the narrative. But Apple, when it went public, had a hell of a time getting through the state of Massachusetts because they thought it was too early and didn't want the offering to be made available in their state. Oculus, which, you know, the VR glasses, went to Silicon Valley and was turned down by a large number of the institutional VCs out there. And then it goes on and raises money in a crowdfunding campaign, a pre-order campaign where young people who thought it was really a neat idea advanced $500. Reg CF was not available at this time, so they couldn't sell an ownership interest, which is unfortunate because 18 months after all these folks pre-order this VR thing, then it gets sold to Facebook for a few $1 billion, and they would have money. So yeah, regulators need to understand their role in our markets, and the congressionally approved authority for the SEC is to make sure investors are properly informed, and that's it.
Yep. That is it. So, Doug, how do you think about the next generation? That's the whole premise of what I'm doing here is everybody's so pessimistic. Everybody looks around. Yeah, our kids are going to be, they're so screwed. You hear it too, right?
Well, you know, I'm with you, Bob. I like being optimistic, and I don't really see reasons not to be. Everywhere I look, I'm impressed by technological advancements, whether or not it's electronics or healthcare. Regardless how controversial Elon Musk is, the things he's accomplished in his life are just staggering. And he's not alone. There are people who are doing those in the life science fields as well. The medical treatments that people are getting versus 50 years ago are extraordinary. I'm reading a book now.
How about just the how much better the entertainment world has gotten? Entertainment is phenomenal
and available.
And, you know, all that money funding all those people and those people getting better and better. The script writing is getting phenomenal. The stories are unbelievable. You can find them anywhere. It's industry after industry.
And less smoking. I mean, there's just so many things that to be excited by. I understand, and this is where I'm loving that you're doing this show, that there's a lot of division, and you and I can have conversations with both sides of the aisle and still break bread and find common ground because yeah, maybe we disagree on who our candidates are, but if you really understand your history and the special nature that this country offers, you really should take stock in what you're living through and what's being made available to your family and friends and children. And yeah, there are things that I find that disturbing and shake me to my core on occasion. But overall, I just can't believe how exciting a time that we live in.
Yeah, and there are some things that could do some damage, and that is preventing people like you from helping develop, empower the individuals out there and the small companies out there from being able to continue to operate. And that's why, I mentioned in the beginning of the show, I'm so happy to get you on, because I don't know how many people have had as big a role in enabling, democratizing capital markets, and on behalf of the progress of our country. Thank you very, very much.
Good. I
But
appreciate the observation. I wish people in government would call. I have lots more ideas to share.
yeah, yeah, I think the idea of a government efficiency program makes some sense. It really does feel that's one of the threats in every country is if you get too much regulation in the way of individual productivity, you really can start to slow down the engine. I think we're probably a long ways away from crushing it. But a little thing here and a little thing there, and pretty soon you can have some problems that get a little bit harder to undo.
Can I give you an example where we're not far off from that, and it's changed markedly over the last 30 years. So one of the things that we've not talked about that we do a lot of are just financings generically of public companies. The ability for sub-billion dollar companies to raise a common stock offering anymore that in a non-highly structured transaction is few and far between.
Wow.
And that's because fund managers have their responsibilities. They don't like taking risks. They don't want to take a long-term bet on a company. And so even though a company may have made it to the holy grail of being public, we have done very little as a society, the capital markets, the SEC, Congress, to create incentives that create long-term ownership and holdings within our smaller universe of public companies on the lower tier. Yeah, everybody wants to be in the Magic Seven or whatever it's being called these days. Your fiduciary duties are only met if you're a fund manager, if you're going into large cap. And the sub-billion dollar companies cannot find banks to bank them or investors to invest on a long-term basis. In small private companies, Bob, I'm sure you're aware of this, we have tax incentives, where they call qualified small investment businesses, where you can get real tax breaks for holding on to your securities for a long time. We don't do that in the public markets. So not only do we have a dwindling number from 8,000 down to 4,000, but if you're in the Russell 2000, go look at the charts. You've been getting destroyed. These companies are thousands of companies with so many employees, and nobody spends any time focused on how we're going to create a stable capital base for them. And it's just not good policy.
Yep, and the post internet regulations and research on Wall Street, which is where my job was, really damage the economics for employing analysts to study and produce research on all of these small companies. And it became, and now, where are we almost 20 years later? Maybe not quite 20 years later, but 15 to 20 years later. And you really see the impact of it. The Russell 2000 loaded with companies, with stocks, I should say, that have underperformed, and a lot of companies that are laden and kind of walking dead.
For the reasons you're saying, there's no analyst coverage, there's no support, there's no investors who want to take a long-term bet. And why aren't we spending time think tanking about those issues? So yeah, there's much more to be done, and that's why I'm thrilled that you're exploring how to do all that.
Well, Doug, it's so good to see you again. Thank you so much. This was really fun. And I certainly learned a lot. I hope a lot of people learn a lot about your efforts over the years. And what are some of the big things that lie ahead? What are your predictions about these crowdfunding and SPAC markets? Do they get healthier from here? Do they still need a lot of work?
You never hear regulators complain about the pipes market anymore. 15 years ago, all I heard about was death spiral pipes and all these things from certain professors. And it's mainstream finance now, just like an IPO. It's not controversial. Major law firms do it, investment banks do it. And SPACs, I believe, now that these new proposed rules have become final that do almost nothing, it gives the SEC cover to go on to their next thing. And SPACs, which will never do what they did in 2020, will just become a nice niche part of the capital markets and do what they're supposed to do, and the way they did from 2010 to 2020. So I think that's going to be very promising. As well as they think that the markets have determined who are the right sponsors for SPACs. And in 2024, the only people sponsoring SPACs are people who've used the program in a way that the investors are comfortable it's worth their while going forward. Crowdfunding, I think, 10, 15 years from now will fulfill the promise and the vision that I thought it would, which is to compete with some of the venture community in getting funding for exciting opportunities. So I'm very excited about that. Crypto, I think, will become more mainstream and regulated because I think it has to be. And I'm always on the hunt for the next innovation so that I can help them on their journey through the various regulatory torment that they're inevitably going to experience.
Well, I suspect the potential of crypto may eventually roll forward. It's really been surprising how many years Ethereum with smart contracts is really the best example where the potential is enormous, but it really hasn't caught hold yet. And maybe that lies ahead over the next decade.
The fund that I invested in, that's what they focus on, Bob. I think you're 100. I actually thought NFTs were interesting because of the capabilities, even though I understand they were being hustled. But yeah, it's a smart contract that had, and there were different levels. I think you'll remember better than I will. Level 1, level 2, level 3 technologies that enabled people to get more memory onto the Ethereum network. But yeah, people will figure that out. But I think it just would be better if it was regulated because I think regulation does create industries and keep, and I understand Mt. Gox is 10 years ago at this point, but there's still other problems that people are experiencing. But let me give you one. Did you experiment at all in crypto?
Oh yeah. Oh yeah.
Okay. So
Yeah.
I put in, some money. I have accounts and somewhere I copied the keys. But what's going to happen when I die? Like, all that stuff's just going to vanish.
There are companies that are already addressing that.
Is that
Yep.
right?
Yep.
Yeah, good.
Yep. No, I mean, there are hundreds, if not thousands, of companies that are coming up with very small ideas and they have a hard time getting known and out there, but there is a company doing exactly that. You go to them and they will set up an automatic process of transfer upon the death of an individual who owns it.
Well, and the one thing we didn't even talk about is just the blockchainization of the existing capital markets, which ought to
Yes.
happen. And
Tokenization, yeah.
it's right, the tokenization. Yeah.
So I know somebody at a major investment bank as they told me that they have a different IT system for every one of their major divisions, and that the tokenization would collapse that down to a fraction of one of them
It
in
would have
headcount.
to. It's so, how about the real estate industry with recording of assets? It's so basic. I don't understand how don't fight it, embrace it, regulate it. If we had done that in 2012, we'd be so much further along.
Yep.
So,
Yep. But there's, the fact is that it's not just ingenuity, it's the perseverance of so many people. And you're a good example of it. Look how much work it took and how long it took
Is
to
that your way
get
of saying,
these
look how
things.
old I've gotten?
You're not old yet.
You're right. But you live through some very frightening moments because you don't know what people are going to do. And it's a
No,
problem.
that is the thing. Predicting the future is so impossible. That's that's uh that's probably why the headlines for negative headlines get so much attention, is that it's easier to worry about how bad everything could get than it is to think about a handful of
It
little
also
good
sells,
things.
it
With
sells news.
yeah.
It sells news. But when you think like, so my older son is a VC and my younger son is a software engineer at Meta. What's not to be excited about?
No. Yeah.
Now, I understand that's not true for everybody. But and I can't speak for outside of our spheres of social spheres, but most people I know are just carrying the torch to the next generation, doing new and different and interesting things.
Mhm.
So, yes, there's lots of reason for prosperity and excitement, Rob.
It is indeed. Um, Doug, great
Bob,
seeing
good
you.
seeing you.
Thanks so much.